To confirm that you hear me. If you confirm that you hear me, we can start with webinar. Excellent, excellent, guys. So today we are gonna talk about my view of the Forex market. So basically this is a new series of webinars just for newbie traders. So basically what we are going to do is we are going to talk about Forex market for would-be traders and for all who maybe haven't had the opportunity to meet a Forex market in its core. Just to present myself, my name is Nenad Kerkez. I'm a full-time trader. I trade for a living, and I've been doing this job for approximately 4 years, and I don't include the demo trading and part-time trading. So basically I trade full-time for 4 years. So we will first present with of course with a risk disclaimer, and by continuing you accept the risk as explained and all other risks related to the Forex market. This webinar is made possible by Admiral Markets. This is my favorite broker, and I have my personal account with Admiral Markets. I don't work in Admiral. I am a full-time trader, but I trade using via Admiral Markets broker. So we are going to talk today about four very important topics. So what is Forex market? What we trade in Forex? Who are the main movers of Forex market, advantages of Forex market, and is it a career job? So basically, can we do it as a career job? So basically, when we talk about Forex market generally, you probably know, if you have ever traveled to another country, you usually have to find a currency exchange. So that currency exchange office is basically an ordinary office which trades currencies from that country for the currency of another country. So usually upon arriving, for example, at the airport, you just before you get to the taxi, you spot a currency exchange office and sell one currency to get another currency. So if you are in USA and you are coming from Europe, you would probably sell euros for dollars. And it would be vice versa if you're coming from USA to Europe. So basically what I'm talking about, when you change euros in dollars, you effectively did a trading part of the job. But yet again, you are still not the trader. So even if you trade currency intraday, for example, you change euro for your national currency, or you change another currency to another currency, that doesn't make you a trader, but that is the very first step in understanding what currencies are and what Forex is. The need to exchange currencies is the primary reason why the Forex market is the largest, most liquid financial market in the world. Basically, that market dwarfs every other market in size, even the stock market, with an average traded value of around $2 billion per day. So up to today, I think the record is 4.9 trillion per day. So Forex market is definitely one of a kind market in the world. And to be honest, I'm really in love with Forex market, so I will present you what opportunities you can have by trading Forex. And all of these webinar series will be just for new traders and for some traders who know a bit about Forex market, but they are not sure what Forex terms are and so on. So we will talk about everything. One of biggest things in Forex is that it is not a centralized market. So this what I'm talking about now, you should all remember once and for all, because many times you would hear on various internet forums, even on some Forex Factory threads, that there are volumes in Forex. Forex does not have volumes because Forex is not centralized market. When we are talking about volumes, quoted volumes, we talk about ticks. So basically, this is not a futures market. This is not a stock market. This is currency exchange. And because of that, it's called over-the-counter. All currency trading is conducted today electronically, over-the-counter, OTC. And that means that all transactions occur via computer networks between traders around the world, rather than one centralized exchange. So there is no centralized exchange, and that puts a Forex in over-the-counter market, and that is not centralized market. The market is open, I can say 24 hours per day, 5.5 days a week, and currencies are traded worldwide in all major financial centers. That includes New York, Tokyo, London, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney, across every time zone. We don't trade Forex in each session. We will pick the session, when to trade. I will talk about it another webinar, but if you want to know when and where you can trade it, you just be sure that you can trade it 5.5 days per week for 24 hours. We have also included cross sessions. That means that when trading day in, for example, USA ends, the Forex market begins a new day in Tokyo and Hong Kong. When Tokyo and Hong Kong ends, we begin a new day in London. Cross sessions are most effective. That means that we want to take part in London session and in cross session of London and New York. Forex market can be extremely active any time of the day, and that means that price quotes change constantly. So that is very important to know. Another thing is that we trade currencies in a form of exchange rate. So we don't say always exchange rate gives the price, it reaches that price. We use the price, but basically when we say price, it means exchange rate. Currencies trade on an open market just like stocks, bonds, computers, cars, houses, and many other goods and services. A currency value, exchange rate, fluctuates as its supply and demand fluctuates, just like anything else. What does that mean? That means an increase in supply or a decrease in demand for a currency can cause the value of that currency to fall. A decrease in supply or an increase in demand for a currency can cause the value of that currency to rise. What does that mean translated to benefits in Forex market? Very big benefit to Forex trading is that you can buy or sell any currency pair at any time subject to available liquidity. And we will come to liquidity later when we talk about Forex brokers, and we always want to trade with a good and respectful Forex broker which has liquidity. That I will talk about it later, of course. So, for example, we have a shorted. I will talk about it later. But for example, if we think that Eurozone is going to break apart, we then can sell euro and buy the dollar. If we, for example, think the price of gold is going to go up, we can buy gold. We can buy Aussie, that is Australian dollar, across to US dollar. So basically, we trade all currencies in a form of exchange rate. What I'm talking about is we trade exchange rates, whether it goes up or down. It doesn't mean that we will make a profit in If we, for example, put a trade in an uptrend, that we will talk about later about that, I will show you now just basics of Forex market. So please, now don't ask me how to make profits. We will come to that. So be patient. Thank you. So it's also the largest money pool in the world. That means that volume, I talk about all money volume, not tick volume. Money volume in Forex market reaches almost 5 trillion as a day trade volume. It's much better and much bigger volume and much higher volume than New York, than London exchange, stock exchange. So basically, we are talking about big money. This is the biggest money in the whole world. It's centralized. Its central point is Forex market. When we are talking about Forex market, we talk about spot market. So this is also a very important thing, because many who would be traders and many economical analysts and economists do not know what spot market is. Spot market is different from the forwards market and from the futures market. Spot market is where currencies are bought and sold according to the current price. So we are talking about what we see. So what we see is what we get. That is spot market. That is Forex market. That price determined by the supply and demand is a reflection of many things, including current interest rates, economical performance, sentiment, technical analysis, fundamental analysis, and perception, for example, of the future performance of one currency against another. So when we execute a deal, that is known as a spot deal. So it is a bilateral transaction by which one party delivers an agreed upon currency amount to the counterparty and receives a specified amount of another currency at agreed upon exchange rate value. So what does that mean in translation? That means after a position has been closed, the settlement is in cash. That is important. It's in cash. We don't trade options. We don't trade papers. We trade cash. Although the spot market is commonly known as one that deals with transactions in the present, these trades actually take 2 days for settlement. So basically, when you liquidate a position, you will get, for example, you will get on the next day, or when that current day closes, you will get analysis of all of your trades with profits or with closes that is specified with your broker. I will talk about that later. So that is basically what spot market is. And the Forex trading in the spot market always has been, it's always been the largest market. Why? Because it's underlying real asset that forwards and futures markets are based on. Prior to Forex, futures market was the most popular venue for traders because it was available to individual investors for a longer period of time. However, we have a big surge of electronic trading, and with that big surge of electronic trading, the spot market has witnessed a big surge in activity, and today it surpasses the futures market as the preferred trading market for individual investors and speculators. We will see what speculators is, what retail traders are, so we will talk about just a bit later. So if you, for example, ask yourself what are forwards and futures market, we won't talk about that because we are concentrating on Forex market specifically, and just to say, unlike the spot market, forwards and futures market do not trade actual currencies. They deal in contracts that represent claims to a certain currency type. So basically, we are just talking about Forex, and we are talking about currency exchange. We are trading currency exchange. So overall, we should respect it. Why? Because Forex market can be very beneficial to us, but also it can be very deadly, and I really mean it, very deadly to our accounts and to our psychology if we don't know how to exploit it properly. So always respect the Forex market and always respect your job. I will talk about it later. When I said respect your job, here we are not gambling, we are trading. And that is the first thing for which a pro trader should take responsibility of. We don't gamble, we trade. That is the big thing you should always remember. So, next thing is to know what we basically trade in Forex. So, I told you that we trade currency pairs. Each pair, what we trade, is also known by its original nickname. So, we buy or sell in currency pairs. So there are major pairs, there are minor pairs. I will show you that. But for example, these are known nicknames of currency pairs, original nicknames. Euro USD, we call it fiber. GBP, Great British Pound, Sterling Pound, dollar is called cable. Euro GBP is called channel. USD CAD is called loonie or the funds. Australian dollar is called Aussie. Great British Pound versus Japanese yen is called Gapi. Euro versus Japanese yen is called Yapi. And New Zealand dollar versus American dollar is called Kiwi. So basically, those are nicknames which traders use. Now I won't get into history how those nicknames have been given, but basically I can tell you, for example, that cable GBP USD pairing is known by traders. For example, its origins, it goes back to the time when a communications cable under the Atlantic Ocean synchronized the quote between the London and New York markets. So basically, that is a legacy from older times. So those are nicknames what we use to trade brokers. I will tell you about those majors and minor pairs. So basically, this can take some time, but for now, for this first webinar, you shouldn't get to know all. We will go step by step. With each webinar, you will get another lesson that you will memorize to your advantage. So basically, we will skip that minors and majors for now. We will talk about in other webinars. Just concentrate that we are trading currencies here and exchange rates. Who are the main movers of Forex market? Who moves the market? We alone cannot move the market because we don't have so much money. We are not big players. Big players are governments, big players are central banks, commercial banks, pension funds, companies. But overall, main movers are governments, brokers, speculators, hedgers, commercial banks, and central banks. Those are main movers in Forex market. Why governments and central banks? The most influential participants involved with currency exchange are the central banks and federal governments. In most countries, the central bank is an extension of the government and it conducts policy in tandem with the government. They do the policy together. Some governments feel that a more independent central bank would be more effective in balancing the goals, for example, in inflation and interest rates, and that tends to increase economic growth. So basically, central banks should be independent of government. But government also has its policy. So central banks and governments are usually on the same page when it comes to monetary policy. Central banks put a lot money in Forex market because they are often involved in manipulating reserve volumes in order to meet certain economic goals. For example, ever since pegging its currency, for example, yen to US dollar, China has been buying up millions of dollars worth of US Treasury bills in order to keep the yen at its target exchange rate. We also have pegged currency in dollar and Swissy, in euro and Swissy, sorry. So basically, central banks use the foreign exchange market to adjust their reserve volumes. Their pockets are extremely deep, and that yields significant influence on the currency markets. So those are the top players in Forex market: governments and central banks. Then we can talk about commercial banks and other financial institutions. So in addition to central banks and governments, some of the largest participants involved with Forex transactions are banks. So most individuals who need foreign currency for small-scale transactions deal with neighborhood banks. However, individual transactions pale in comparison to the volumes that are traded in interbank market. So we are trading on interbank market, and that market is the market through which large banks transact with each other and determine the currency price that individual traders see on their trading platforms. All of those banks transact with each other on electronic brokering systems that are based upon credit. Only banks that have credit relationships with each other can engage in transactions. The larger the bank, the more credit relationships it has, and the better the pricing it can access for its customers. That means the smaller the bank, the less credit relationships it has, and the lower the priority it has on the pricing scale. So banks in general act as dealers in the sense that they are willing to buy or sell a currency at the bid-ask price. So one way that banks make money on the Forex market is by exchanging currency at a premium to the price they paid to obtain it. Since the Forex market, I told you already, is a decentralized market, it's common to see different banks with slightly different exchange rates for the same currency. And all central banks are involved in buying, in selling, in all sorts of dealing with currency pairs. So they also have a large part of trading in Forex market. Then we talk about hedgers. Hedgers and speculators. One of the biggest clients of these banks before mentioned are businessmen that deal with international transactions. So basically, we have, let's say for example, that a German company orders some equipment from a Japanese manufacturer to be paid in yen 1 year from now. Since the exchange rate can fluctuate widely over an entire year, the German company has no way of knowing whether it will end up paying more euros at the time of delivery or less euros. So one choice that a businessman can make, for example, to reduce the uncertainty of a foreign exchange risk, is to go in the spot market and make an immediate transaction for the foreign currency that they need. Unfortunately, those kind of businesses may not have enough cash on hand to make spot transactions, or may not want to hold massive amounts of foreign currency for longer periods of time. So they frequently employ hedging strategies in order to lock in specific exchange rate for the future, or to remove all sources of exchange rate risk for that transaction. So those are hedgers, and they also have a big part of trading and in Forex market, and most of them are companies. So in order to avoid financial loss, they hedge. Then we talk about speculators. All of us retail traders and investment fund traders are speculators. So what are speculators? Rather than hedging against movement in exchange rates or exchanging currency to fund international transactions, speculators attempt to make money by taking advantage of fluctuating exchange rate levels. You have all probably heard of George Soros. He is the most famous and infamous of all currency speculators. So if you know the history, that guy, that man, he was a fund manager, and he was speculating on the decline of the British pound. And over a very, very short period of time, he got into the move that earned him 1.1 billion, and that was finalized in less than a month. So basically, he is one of most famous speculators in Forex market. Also, on the other hand, Nick Leeson, he was a trader with England Barings Bank, and he took speculative positions on futures contracts in yen. And that resulted in losses amounting to more than 1.4 billion. And that led to the collapse of the company. So, one of the largest and most controversial speculators on the Forex market are hedge funds, hedge fund managers, which are essentially unregulated funds that deploy unconventional investment strategies in order to reap large returns. But all of them have the access to Forex market, and all of them trade in Forex market. And that is the good thing overall if you watch it, because we are the small fish, and we can eat following big fish. So that is basically the main principle of Forex retail trading. We are small fish, and we are following the big shark, and we can always make money, we can always eat when that big shark passes through all of the food chain. If we get a good strategy, we can make money. That is the most important thing in Forex market, to make money with a small risk. So those are all players who put money in Forex market, and Forex market is moved by all of these different kind of players: governments, brokers, central commercial banks, companies, speculators, and hedgers, of course. So what are then the advantages of Forex market? For example, in comparison to other markets, stock markets, forward spots, or future markets. There is liquidity, and that means what I already told you. The main advantage of liquidity is that it's huge trading volume, and it represents the largest asset class in the world, and that leads to high liquidity. Also, it's geodispersion. That means geographical dispersion. It's traded all over the world, so it doesn't matter if you trade from your home, or from your office, or from a beach, or from a secluded island, or from New Zealand, or from anywhere in the world. So geographical dispersion is one of advantages. Also, a continuous, non-stop operation. That means it's constantly in a move, 24 hours per day except weekends. And that means trading from, for example, 20 or 8:15 p.m. GMT on Sunday until 10 p.m. GMT on Friday. So it's non-stop operational. It's fast moving. That means that if you know how to do it, you can earn a lot of money in an hour or in a second if you know how to do it. It's extremely fast moving. It's like an airplane compared to other markets. And you always should take advantage of that. That is a low margin. That means low margins of relative profit compared with other markets of fixed income. So basically, due to extreme liquidity of the Forex market, margins are low and leverage is high. So it is just not possible to find such low margin rates in the equities markets. Most margin traders in the equities markets need at least 50% of the value of the investment available as a margin. Whereas, for example, we as Forex traders need as little as 1%. Furthermore, commissions in the equities market are much higher than in the Forex market. Traditional brokers ask for commission fees on top of the spread, plus the fees that have to be paid to the exchange. Spot Forex brokers take only the spread as their fee for transaction. So basically, margins are low, leverage is high, and that is very, very, very big advantage in a Forex market. I will talk about leverage a little bit more when we have another webinar. I will talk what leverage is, what you can use, how you can use leverage in your advantage, to your advantage, and correct use of leverage, because it can be your friend and it can be also your enemy. So we will talk about that. Also, advantages of Forex market are profitability, minimal account, fast results, and minimum time spent for investing. Profitability means we are using an adequate trading strategy which we can become profitable. So profitability is the main thing. We should always try to be profitable. Even if we are not profitable for 1 month, next month we try to be profitable. And that we do by using an adequate trading strategy. Also, minimal account. We can start trading even with $10 initial deposit. And again, leverage is used to trade with minimum deposit. The amount of leverage acts as a double-edged sword because investors can realize large gains when rates make a small favorable change. But they also run the risk of a massive loss when the rate moves against them. But yet again, without a leverage, many traders couldn't trade because it gives the access, that leverage gives the access to very, very small accounts. Also fast results. We can open and close our positions in a matter of seconds. And yet again, we should always find a broker where we can safely close our position without being slipped or without being requoted. That is also one of the reasons I use Admiral Markets. I never had any requotes. I always get a price what I see. So basically, it's very, very useful to know that in Forex market you can open and close your positions in a matter of seconds. Then again, minimum time spent for investing. We can trade even if we have a day job because Forex never sleeps. Forex indeed never sleeps. So those are very, very big advantages of Forex market. Then again, many people would ask me, is it a career job? Can we make a career in Forex market? And now I will tell you that basically to have a career in Forex market, that is very hard to say because it's a personal thing. When I started doing Forex job, I was employed in a company, and it was a very, very hard job. The payment was irregular, and that is the thing I hate the most, really. It was really hard to earn a payment. Then that payment was not enough comparing to my needs. You know, it was all, I was a good worker, but then again, the company didn't have a very good assets to pay me. So basically, that company is closed now, and just prior to closing of the company, I told myself, well, I will start a career as a full-time trader. So I quit my day job and I just went to full-time trading. Basically, what I did is I traded part-time when I was employed, and I switched to full-time after I quit my job. But then again, we need to have a vast knowledge of the Forex market. When I start trading full-time, I had hours and hours of screening time. And I really I had many demo accounts which I used. I wanted to know how to trade. I practiced a whole lot of different strategies to know what style of trading I will employ when I get full-time job in Forex market. So I managed to have I think it was 6 or 7 months I was profitable. So I saw that at least we need at least 6 months to 1 year, full year of constant profitability to have Forex as our full-time job. So when you for example practice on demo account, you should always try to work as you would work with real money. And that was one of my favorite strategies. I worked on demo account basically as I worked with my real money. And then I saw the full potential of Forex market. I didn't want to gamble. I wanted to have constant income. Even if I don't have a constant, for example, there can be months when I lose. It's not much, because my strategy which I use is not to gain as much and not to lose as much. And that I will explain that also when we talk about money management in one of our webinars. So if you want to make 2 or 10% per month, then your drawdown should never exceed that 10 or 15%. And that is all can be achievable by demo trading. So prior to being profitable, you need to demo trade your strategies, and you need a screening time. So you should never take Forex as mechanically. That is not a mechanical job. That is why most of the systems don't work. You cannot trade mechanically. That is why most of robots don't work. They can be profitable 1, 2, 3, 4, 5, 6 months, maybe a year. But then another year, when market conditions change, that can be disastrous to your account. And there is nothing that can be better than a human mind. There is no computer, there is no robot, there is no strategy that can be better than a human mind. So that is very important. Prior to being profitable, you need a screening time. Look at the price, watch the price section, watch how those ticks are formed, watch those waves of price. When you start dreaming about price, and when all those come to you in your dreams, then there is a first step. Then you're becoming a real professional trader. So you need all possible opportunities to have for screening time. Be as much as you can by your monitor to watch price action. Why? Because eventually that will save you a lot of trouble with mechanical trades. For example, your system will tell you buy a dollar or buy euro dollar, but your gut, I need to say gut quoted, your gut feeling will tell you don't do that. And that is achieved only by screening time. That will eventually help you in your trading. And believe me, that saved me a lot of time, that gut feeling. feeling inside me, because I had a lot of screening time. Prior to being a full-time trader, I monitored the price anywhere from 6 to 8 hours per day for full 2 years. So just imagine how much screening time I have. Also, never search for Holy Grail, because on many forums you will see many traders use that term Holy Grail. You are the Holy Grail. Never search for it. If you want to start trading, try to find a good strategy. Whether we will talk about that. I will talk about strategies in one of my next webinars. Whether you are a full-time trader, whether you are part-time trader, whether you, for example, have a day job, or you want to exploit scalp trading, or you want to exploit intraday, intra-week trading, never search for Holy Grail. That Holy Grail is you. You yourself. When you find a strategy, try to practice with that strategy. If you feel comfortable with it, don't change it. First, get a screening time to know what price is. Again, then you find a strategy, then you employ it. And don't search for Holy Grail. You can switch 50 different strategies, but don't search for Holy Grail. Holy Grail doesn't exist in that literal sense. Holy Grail is you, your psychology, and your mindset. That is Holy Grail. You just need the ways to communicate with yourself, and you will find that Holy Grail. So that is clear, and that is really what I wanted to tell you. If you want to start trading, don't search for Holy Grail. You will not find it in literal sense. Then again, you can be a trader or you can be investor. What that means, if you're a trader, you will trade and you will pool the money, you will withdraw the money for your day living. For example, you want to go in cinema, you want to eat, you want to pay your bills, you want to buy a new car, you want to go on vacation or holiday, then you're a trader. Or you can be investor. That means, for example, you have a lot of money, but you don't want to be bothered with trading. Then you give a good trader your money to make a portfolio for you and to trade for you. You basically are not a trader, but you are an investor. And by being an investor, you have a full access to your account and to your equity and balance. So basically, there is also a job to be investor. That's not a useless thing. That's a good job to be investor. Because I know many people who have the money, but they just don't know where to put that money. And then I tell them, okay, I will show you how I do it. For example, you can see my results, etc. Or you can find another trader. I don't know. It's okay. Maybe you want to find another trader, and you want to put money with him or her. So you can be a trader or you can be investor. Another thing to know, anywhere from 2 to 10% per month is great. And I just know that many teachers or mentors will tell you that they make 30% per month. And then there is another question which I ask them immediately when they tell me that. So if you're making, for example, 30% per month, how much drawdown are you willing to risk? And usually what I hear is if I want to make 30%, I will risk up to 40–50% of equity. Well, that is too much, because pro traders don't use very high leverage. I'm talking about leverage. I don't talk about small accounts. If you, for example, have $100, of course you will need to use a very big leverage in order to grow that $100 to $1,000 and even to $10,000 or more. So then you need to use high leverage, because it will take many months or maybe years to get a full account if you use a low leverage. But being a pro trader, believe me, you will
you will do with a lot of money, and then you won't need to use very high leverage. You won't have to use you will use 1 to 5, 1 to 10 leverage. You just won't use 1 to 50 or 1 to 100 leverage. So what I'm telling you is, when you have big money to trade with, anywhere from 2 to 10% per month is great. Banks will give you 5% on a yearly basis. 5% per yearly basis, and you can make anywhere from 2 to 10% per month. So basically, you will all try to make that 2 to 10%. We will talk about money management, so I will show you how to do that. Always respect your rules. That means when you start to trade and when you want to trade, first you make a plan. Then you make your rule set. And if you hold to your rule set, you will get another 10% of a potential success in Forex market. If you don't abide by your rules, that can lead to gambling, and that can lead to very bad things in Forex market. So always have a plan. So guys, this is just the beginning of our mentorship, or my mentorship in Forex for new traders. That means I just want to say, for new traders, this is very beginning. So if you have any question to ask me, don't hesitate to ask me. Any questions, if you're, for example, a revisiting trader, or you are, for example, you listen to mine and Chris webinars, those are webinars, for example, for a little bit experienced traders. But these sort of webinars are for novice traders. So if you have any questions, don't hesitate to ask me. Paul is asking me how many more minutes. This is basically the end. If you have any questions, this is the end of this first webinar. Just introduction to Forex market. We will have one webinar per week to novice traders, and all will be clear to you after dozens of webinars. You will know how to trade, you will know what leverage is, what PP is, what currency you should trade, what markets you should exploit, what sessions. So this is the first webinar. This is introduction to Forex. So yet again, if you have any questions, you can ask me, no problem. How large leverage you will use? Okay, I will talk about leverage next time. I will talk about leverage next time when you will see in one of our next webinar. I will talk about. But basically, I rarely use more than 1.5, 1.10, or at the most 1.20. But 1.5, 1.10 is my usual leverage, what I use. And if you ask me, maybe you don't know exactly what leverage is. As I told you, leverage can be a real friend and a real enemy. For example, it is possible for a trader to control a position of $100,000 by putting down as little as $1,000. And that we borrow from our brokers. That is the leverage. So this amount of leverage acts as a double-edged sword, because investors can realize, as I told you, large gains. But also there is a large risk of massive loss. So basically, my advice is always to use 1 to 5, 1 to 10. If you have if you, for example, use a 10K account. For smaller accounts, you just need to use bigger leverage in order to grow that account. So I will teach you in one of our next webinars how to use leverage to your advantage. I know many traders who use leverage and they sweat during the trading hours. They are praying to the God that the price reverse or that the price reverse in that sort of direction. That is not the thing we should ever consider. If you use a large leverage, how you ask me, you should always need to realize that you will have a potential big loss. That maybe you will have a big loss. You can have a large gain. But what if price reverses? Then you will have a big loss. And it will take more time to compensate for that loss than it initially is lost. So basically, if you lose in one day 10%, you will have more time to compensate. You will have, for example, a month to compensate because you use the leverage and then you're afraid to use that leverage again to compensate for that loss because you are not sure whether that second attempt to compensate for that loss will lead to a loss or a gain. That is a psychological thing, and leverage is indeed psychological thing. So you always need to consider that when trading. If you are willing to risk 50% of your account, then use. But that is not my advice. I just saying that you being potentially a pro trader, if you want to trade full-time, you won't use very high leverage. You will use leverage, but you won't use very high leverage. On 10K account, I usually open one lot or 0.5. Sometimes I go with 0.3. So anywhere from 0.3 to one lot for each 10K. So that is how I usually go with leverage. If I'm extremely sure with what I'm doing, I can use just a slighter big lot size, for example, 2 lot size, but that is because I have a screening time, and I just sometimes I don't need to see price action. I just want to see the price exactly how that is, and I can tell whether it will go down or up. So basically, leverage is what I use to my advantage. I just don't want to risk my whole account to compensate, for example, for a loss which have been made in past 2, 3, or 5 days. So that is the answer to your question. I will talk about that leverage a bit. I will talk in our special webinar, but just for now, my advice is don't use very high leverage. I know that despite the foreign exchange risks, the amount of leverage available in the Forex market is what makes it attractive for many traders. So it is indeed attractive, but also you need to use it to your advantage. So again, guys, if you have any additional questions, you can ask me now. I will respond. If you don't have any more questions, we then can conclude our webinar, and then you will see in our next webinar we will talk about some more things about Forex market, and it will be more clear to you. So another question is, what's your return to risk ratio per trade? Well, again, Andrew, right? Andre. The right answer to your question is, I don't have a fixed amount. For example, there are a few different strategies which I usually use. Those kind of strategies are intraday trading and scalping. We'll talk about that in one of our next webinars. If I scalp, I go with 1-to-1 risk ratio. And for example, if I go with intraday trade, I go usually with 1 to 1.5 or 1 to 2, for example, risk to reward. So if you scalp, you just need to know that your risk to reward can be just that big.
But if you want to make intraday trade, for example, with a bigger stop loss, then you can go with more risk to reward. So I will talk about that when we talk about specific strategies for intraday or intra-week trading. Then I will explain what sort of risk to reward you go with scalping, or what sort of risk to reward you use when going intraday or intra-week. Those are all different kind of things. So there is not fixed thing. Let's say I go with 1 to 2 risk to reward. That is just not correct, because price can fluctuate, and I will close, for example, a trade when I see that the price is going to reverse. So for example, I don't go with full risk to reward. Markets are constantly changing, and you need to adapt to that market. So there is no universal strategy you can go with when trading full time. Sometimes you will use intraday, sometimes you will use scalps, sometimes you won't trade at all, because if you, for example, not having a position sometimes is equal to having a position in Forex market. We won't trade when there are bank holidays, we won't trade when there are big news, we just want to stay out of trade when there are bank stress tests or some volatile events. So there is no clear, no one strategy that you will use when trading. You will use strategy adapting to the current market conditions. So you won't always use only one or very one strategy of your choosing. So sometimes you will use scalping, sometimes you will use intraday, sometimes maybe you will use intra-week strategy. So it depends what kind of trader you are. So that is the answer to your questions. Another questions what I see is how much percent of your account do you risk per trade? Andre, I don't, as a professional trader, I don't, there is how can I say, unusual question, because I don't have a fixed amount. I always use stop losses. So, for example, let's say an average. For an average, I use 1 to 2% per trade. For example, I can use 1% of risk per trade. If I am scalping, then I can go with 3% of risk per trade. Maybe that sounds big to you, but that is because I know what I'm doing. That is the thing. When I started with Forex trading, I had burned many demo accounts, until I realized what I need to do in order to become a profitable trader. So 1% for standard trades and up to 3% for scalping trades. That is the answer to your question. How many hours a day you trade as a professional trader? A good question. This is a very good question. Trading hours is also part of our next webinars, where I will explain you how you will use trading hours to your advantage. Believe me or not, sometimes I trade only 5 minutes per day. So if I get an average, I can say I can be in front of the screen to monitor the price. But effectively, I don't trade more than 1 hour per day. What does that mean? That means that if I make a position, for example, early in the morning, I will go out of my computer and I will monitor the price for my phone. I will monitor the price for my phone. I won't open any trades from my phone anymore, but I will just monitor the price. And that kind of trading is intraday trading. That means that either it will hit my target price, or I will close it earlier, or it will hit my stop loss. So basically I put a trade and I go out. If I scalp, I do that
in the first 3 hours of each session. That means first 3 hours of London session and the first 3 hours of New York session. That is when I scalp. And if I make intraday trade, I usually make a trade after I analyze the market, after the price has come to my level, then I open the trade and I go out. So basically, that is the answer to your question. Averagely, I spend 1 hour of active trading per day. No problem. But you will have a different styles of trading. That is my style. Why? Because if I want to scalp breakout, I need to wait for price to reach resistance or support, then I will exploit breakout. If I want to have an intraday trade, I want a retracement to some sort of level before I got into position. So basically, most of the time you will wait. You won't trade actively. You will wait for the price to come to your preferred level. So if that's trading, then it's more than 1 hour per day. But that, I don't think that is a trading. Trading is when you open your position and when you manage your position. So basically, most of the time it's waiting. It's waiting for the price to touch the level for buy or sell, and then after it touches, you go out. You put your stop loss and you can go out. So basically, that is the answer to your question. If you scalp, then you will have a lot more to do. If you're active scalper, then you will exploit these first 3 hours of each session. That is when you scalp. So that is the answer to your questions, Andre. If there is another question, I will gladly answer it. If there is no other questions, we can finish with this initial webinar. And we will continue in a week. We have another question. How many computer monitors you use in trading? Currently, I have a laptop, and it's a 17-inch screen, and I have a monitor of 25 inches. Because it's a tricky question. You probably have seen many traders which use many monitors when they trade. I just don't do that. I am a real example of a guy who can trade even with a single laptop. I almost never need my laptop. It's just helping me, for example, to monitor some other pairs which I don't trade actively. So basically, I can say that I use only one monitor per if I want to trade. I will teach you how. You just don't need more than one. Believe me, you just don't need more than one. Those are all telltales and rumors and different lies which people are telling you. You need 5, 6, 10 monitors. Why? You don't need that. If you know what you are doing, believe me, you can trade with a laptop, with a simple 15-inch screen. So that is the answer to your questions. I have a laptop, I have a 25-inch screen, but really I don't need it. Because my kind of trading is pure price action. I just want the price to touch the levels which I use, or if I scalp with 1 minute time frame, I just need to see the channel, and then I can trade. I just don't need those. Why would I need 3 monitors? I just don't need it. I always know when important news is. Then I don't trade. 30 minutes prior to big news, I don't trade. I know when big news is. I watch Forex Factory calendar. I watch Forex live. So I really don't need to have all monitors turned on. So if you ask me, I can do with a single laptop. But 25 inches is okay for me, really. More than enough, I can say. So that is the answer to the question. The best web page for Forex. Of course, I can be a little bit subjective the best web page for me is Forex Factory. I run a thread on Forex Factory. It's called Spider's Den. You can visit Forex Factory here, forexfactory.com. Forexfactory.com. That is the page you should look for, and my thread is called Spider's Den. My nickname is Tarantula. I use that nickname since I have started with trading. So basically, the best page for Forex trading is indeed for me Forex Factory. Just because I do the analysis, it has a good calendar, and it has many systems where you can try to be profitable. You can try to grab for a free. So you don't pay anything to Forex Factory. It's a free source of information, so you can always browse through it. So it's forexfactory.com. My trade is Spider's Den. It's called Spider's Den. My nickname is Tarantula. You already know that. And also I use Worldwide Investment, for example, to post my strategy and to post my intraday setups. So I advise you to visit either Forex Factory or Worldwide Investment, but you can always follow me and through Admiral Markets page. So it's a Spider's Den. It's name of a thread. So I will show you now. It's forexfactory.com. And Spider's Den is called my thread, and my nickname is Tarantula. So there is good web page for Forex. How many trades per month? Basically, how many trades, it depends. It depends of market conditions. I have approximately 2 to 4 trades per day, but I don't trade every day. I won't trade, for example, on Thursday. There are many big events on Thursday. I won't trade. But for example, 4 days per week, I usually trade. 4 days per week. And I personally do anywhere from 2 to 4 trades per day. What is the other side? The other side is you try to find Worldwide Invest. I think it's called Worldwide Invest. You Google for it, it will be on the first page, Worldwide Invest. So those are Worldwide Investment forums. You just type Worldwide Invest, it will bring Google search for that. Yeah, Worldwide Investment. Yeah, Worldwide Investment. Exactly, Andre. That's the second site. I started posting on that site, I think it's 1 month ago. And I post on Forex Factory for 4 years. Not 4, but maybe it's my 3rd year of posting. And I've been running my personal thread for 2 years. So you will find a lot of useful information there. No problem. You always, of course, you can always try to watch for Admiral Markets blog. I do analysis for Admiral Markets page. I also do analysis for personalized Serbo-Croatian Admiral Markets blog. I also do analysis for Forex Ball. I encourage you to try Forex Ball. Forex Ball is very good thing to practice your strategies. It can bring you money because it's free, and the best trader always gets a prize in real money. So I encourage you to get to Forex Ball page and try to trade, because you won't lose anything. You can gain and you can practice your strategy. So that is Forex Ball. So basically, that is the answer to your question. Yeah, that's Worldwide Investment and Forex Factory. So, guys, if you don't have any questions, we will continue on next Monday. We will go step by step. We won't rush into anything, and I will explain you all you need to know about Forex market. As always, guys,
as always, Admiral Markets is in social media, on Facebook, Google Plus, and Twitter. So you can like Admiral Markets in social media. Don't forget to follow my analysis. They will help you in trading. I'm sure about it. And you can always comment whether you like it or not. And thank you guys and girls for your attention. I'm eager to see you in a week, and we go step by step. I promise I will explain everything. I will explain all of your questions, and you will have a lot more understanding of Forex market is. Thank you for your comments. Thank you very much, and see you on next Monday. Cheers and bye-bye.
The